All right, let's get right into it. Today, we're breaking down the latest earnings report from MSC Industrial, that's ticker MSM. So here's the puzzle we're going to solve today. On one hand, the company reported a solid beat on its adjusted earnings, but on the other, the stock took a pretty sharp dive right after the call. So what gives? Let's dive in and unpack this contradiction. Okay, here's our game plan. We'll hit the big numbers, figure out exactly why the market got spooked, and then I'll give you our take on what's next for the stock. Simple as that. All right, first up, a quick look at the headline financials from Q1. So when you first look at the numbers, it's a bit of a mixed bag, right? GAAP earnings missed by a couple of pennies. But, and this is the important part, the two numbers that investors really zero in on, that's adjusted earnings per share and revenue, they both came in ahead of what Wall Street was expecting. Now, usually, that's a perfect setup for the stock to go up. And here's the star of the show, at least on the surface. Adjusted EPS came in at a strong 99 cents. That's a solid 4 cents better than the forecast, and it shows some pretty healthy growth compared to last year. You know, this is the number that kind of cuts through the noise. It strips out any one-off stuff to show you how the core business is really doing. And it's not just earnings. The top-line revenue also beat, growing 4% to almost $966 million. So let's recap. We have a beat on adjusted earnings and a beat on revenue, which brings us right back to that big question, why on earth did the stock sell off with numbers like these? Well, to figure that out, we've got to peel back the onion a bit. We need to look past those shiny headline numbers and see what's really going on underneath, especially when it comes to what the company is saying about the future. And here it is. This is where we start to see the cracks appear. You see that 4% sales growth, right? Well, if you break it down, you realize something pretty startling. The entire gain, and then some, came from just hiking up prices. The actual number of products they sold, the volume, it actually went down. And that's a big red flag that tells you underlying demand is getting soft. And it looks like this isn't just a one-time thing. Management basically told everyone to expect more of the same. They hinted that price hikes in the second quarter could be even bigger, maybe more than 5%, because they're trying to fight off rising costs from their own suppliers, especially for things like metalworking products. Okay, so this is the part that really sent a chill down Wall Street's spine. The outlook for the next quarter. Management pointed to three big headwinds. First, they said December was weaker than they thought it'd be. Second, there's this big supplier conference that's going to push some sales into the next quarter. But honestly, the real kicker? They basically admitted they have very little idea what demand is going to look like in January and February. That kind of uncertainty is something investors absolutely hate. So, when you bake all those headwinds into the official guidance, well, it points to a slowdown. Their forecast for average daily sales growth, which is a key metric, just wasn't what the market was hoping for. It was pretty underwhelming, to be honest. So, let's take all of this and see how it shapes up into our final call on the stock. All right, we've crunched the numbers, we've listened to the guidance, so here's our official take on MSC Industrial. So, the big question. What's the final verdict on MSM? When you weigh the good, that strong pricing power, against the bad, the weak volume and that super cautious guidance, where do we land? We're calling it a market perform. And this slide really lays out the tug-of-war perfectly. The bulls will tell you, hey, the company's doing its job, they have pricing power, and they're growing with their most important customers. But the bears are looking at the bigger picture. They see that the manufacturing economy is actually shrinking. That's what that ISM number below 50 means. Plus, the company isn't doing a great job of turning its profits into actual cash, which is what weak free cash flow conversion is all about. That just adds another reason to be careful. So looking ahead to next quarter, here's our prediction. We think the results will land right around the middle of what management guided for. And you can expect the story to be pretty much the same. Price hikes will probably save the day by covering up for soft sales volumes. Because of that, we see the stock being stuck in a rut, just kind of range-bound. It really needs a clear sign that industrial demand is picking up before it can make a big move one way or the other.
And finally, before we go, just one last very important thing.
This is not financial advice.